Thanks for listening. Join me next week, and if you have any questions, you can reach me at 772-872-6332. Again, that's 772-872-6332, or at mindiemolina.com. Mindie Molina Investments and Insurance has been protecting the retirement of families for 15 years. They can be reached at 772-872-6332 or at mindiemolina.com. Advisory services are offered through Aegis Wealth Management Incorporated. The firm is registered as an investment advisor with the SEC. Information provided by Mindie Molina Investments and Insurance and or its affiliates are for informational purposes only and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. This is Mindie Molina and Frank Borelli today on the Mindie Molina Show at WCNL. We are grateful that you're tuned in, and today we're going to be picking up where we left off last week, discussing Social Security planning and also tying that right into income planning altogether in retirement, which those two things go hand in hand. Social Security is obviously a huge piece of the puzzle when it comes to having a solid income strategy in retirement. And like I always say, you want to invest to retire. Now, if you have enough money that you're not worried about retirement, then you know what? Good for you. God has blessed you. But I know many of us listening do have concerns around retiring and not running out of money. And how do we not run out of money? Well, don't run out of, Frank?
Income.
Exactly. If you don't run out of income, you're not going to run out of money. And God loves Social Security because it keeps a lot of people going in their later years of life when their nest egg does start to become depleted. And I've seen it happen. And sometimes it's because of poor planning. Could be market downturns early on in retirement, which are called what risk, Frank? Sequence
of returns.
Sequence of returns. Yeah. Sometimes I try to see if Frank can know what my mind is saying. He's pretty good at it. It's pretty good. I think I talk too much, and now he just knows what I'm about to say. But yeah, sequence of returns. It can really it can make an entire retirement plan go bust.
And when we're talking sequence of returns, the focus is the markets. You're in the markets.
Yes, and it's a huge risk.
The portion of your portfolio that's in the market, if you're trying to build your income based off of the market, if the market is in a downturn, you can have serious problems because the percentage you're trying to live off in retirement is going to be a bigger piece of your pie than you had been anticipating, potentially.
Right. And one of the reasons that it becomes an issue in retirement is because this is when you're taking income from your nest egg. So now you've had a portfolio all this time and it's gone up and down with the market, and that's fine. It goes down, it comes back. But it's when you start taking distributions from it that a downturn in the market can seriously impact you, and it doesn't come back the way that it did because you're having to sell off positions that have lost value, and in order to meet your income need, now you're having to sell more positions than you would have, and then the next thing you know, it comes back significantly less than it was, and it's not enough to keep you from running out of money based on how much income you're spending each month. And the thing of it is, the bills keep coming, right? You still have to keep your lights on. You still have to buy groceries. You're still buying gas. You still want to go to the movies or to dinner every now and then. And if your expenses aren't going to go away, then your income better not go away either. Right. So the key to Social Security is that it is a lifetime income. It goes on forever. And it used to be that we had pensions that we could count on. Frank is blessed enough because of his service that he does have a lifetime pension. But the percentage of retirees that have a lifetime pension, Frank, since you've been working with me and we've been working with retirees, how often is it, on your experience, that someone comes in and has a good solid pension like you have?
Very small percentage. I think there might have been one that we met with in the about 2 years that we've been working together.
Yeah, that's kind of crazy, right?
I think it was one, maybe two.
If I had asked you that question before you started doing this for a living, would you have thought it would be much higher?
Yeah, well, I would think it would be higher, yes. But we know, I mean, the whole 401k, that's a recent, in Roths, that's all recent changes to the law because there's a lack of pensions to support employee retirements.
Right. So I'm saying all of this stuff to kind of really tee up the importance of taking your Social Security income really serious.
Right. Planning, using a planning tool to figure out the
exactly
multiple ways that you can take it, and understanding there's a lot of rules.
A lot of rules
with when you take it. If you take it before full retirement age, there's income restrictions on that benefit.
Yeah. So last week, if you missed the show, you can get it online. Correct, David, at WCNO.com?
Usually, but that feature is offline right now.
So you can also get it on our YouTube channel or Facebook page, Mindie Molina. If you go on our channel, this is a live show. If you have any questions, or maybe you're thinking about retiring in the next few years and you're not sure if or when you should take Social Security, at what point, then for sure, give us a call or schedule a consultation. We'd be happy to sit with you and walk you through some different strategies. But the most important thing is that you understand saying, oh, well, I'm not gonna take Social Security until I'm 67, or I'm gonna wait as long as I possibly can, or I'm gonna take it at 62. Don't just wing it.
Right, or when I retire, I'm going to take Social Security. Like, is that connected, or maybe there's two different events? When I stop working and when I take Social Security may not be
at the exact same time.
Date.
Right, exactly. So what we do is we really help you maximize your Social Security benefit, because at 67, that's how much you're entitled to. So all the number that at full retirement age. For most of you, for a lot of you, it's going to be
1960 or later. If you're born 1960 or later, it's age 67, the full retirement age.
That number that they're offering you is your full entitlement based on what you've contributed, your highest 35 years. And then if you take it before age 67, you're considered to be taking it early. If you wait until and you go at 68, 69, 70, that's considered, taking it later. And because 67 for a lot of you is the full retirement age, is the break-even point, right? So that's what the number's based off of. Why would someone take it early? Because they don't have enough assets to fill the income gap in order to defer it. Why would someone not take it when they become eligible to take it?
Because they have enough income to support their budget, because they've done a detailed budget analysis or expense worksheet. Same thing. You got to know what your expenses are so that you know what income you need.
Exactly. So if you are able to defer it, a lot of times it's not in every single situation. This is why you have to do the work with someone like us that is going to show you this is how to get the absolute most out of your Social Security based on your financial situation, because everybody's is different. So
how expensive is the planning tool that we provide?
It's zero cost. There's zero expense for meeting with us.
And we have an office in Stuart. You're listening to the Mindie Molina Show. This is a live broadcast. You can call in at 772-221-1100, 772-221-1100 if you want to talk anything financial with Mindie and Frank on the Mindie Molina Show.
Yes, and we can also do Zoom, and we can visit you in your home if you're more comfortable with that. We're pretty flexible, Frank and I. So what I want to do today is kind of pick up where we left off with our Social Security discussion and really go back to the different examples. So the end of the show last week, we were starting to run out of time, and I didn't get to really dive into them as much as I wanted. And I think this is by far one of the most important pieces of the puzzle, even though on the radio, it's kind of difficult to explain because you can't see the graphs, you can't see the charts. But I am going to do my absolute best because I want to drive home the point that when you take Social Security can really matter in your 80s, 90s. Okay, it can really impact you. So here's why. This is an example of, let's see, this is a couple, dual income earners, so they both contributed. They started Social Security at age 62 years old. They have $2.5 million of investable assets. So that does not include property. Those are things that they can put in the stock market or investments that are going to produce income for them. And they are married and earning a joint together about $200,000 a year. So on this one, if they started Social Security early at age 62, they retire at age 69 and 65. So everything goes good. The problem is starting out in Social Security, they're only getting jointly together $2,783. So let's say $2,700. So they're getting $2,700 roughly. And as time goes on, see, the key to Social Security is that, yes, it's a fixed income, but it goes up with inflation. So what do we know about the cost of milk over the last 20 years? Right? What do we know about the cost of electricity over the last 20 years?
Going up.
Right? So what do we think is going to happen over the next 20 years?
Going up.
There's a really good chance those prices,
called inflation.
We call it inflation. And a huge part of retirement is inflation. We don't know what your expenses are going to be 20 years from now. Frank has a good saying. What is it? Go.
Yeah, the three aspects of retirement. Some people, they call it, as you retire, there's the go stage, the go slow stage, and the go no stage, no-go stage.
Exactly. So go slow, and then no go. Exactly. So the assumption there is that as you age, your expenses might start to slow down. Although I have a client right now, actually I have two ladies who have been with me for years. So the one I'm thinking of right now has been with me since 2009.
You can see her on the ship right now.
She is right now on a month-long cruise. And
good for her. Praise God.
Yeah, and another lady that both of these women are in their 80s, don't even know each other, but they just happen to be both my clients, and both of them this year did
One
or
of them was
are
on the
doing
program before.
Oh yeah, Betty, she was in the program with us. Month-long cruises. So to think that you slow down, I don't know anymore. I think people are living longer, healthier, and they're more active, and that's great.
But the amount of the expenses.
Yes.
The amount of the expenses and the activity.
Either way, it's our job to believe that your expenses are going up. And it's a blessing that Social Security does go up. Now, for years, I haven't seen much inflation in Social Security until recently, which is huge.
Well, that's because
it was really good.
Was artificially. Many economists were saying the Fed years ago should have been raising the interest rates to slow things down, and so
well, based on what I was seeing with
then the government changed the definition of inflation years ago too. That's why there was no bumps,
no cost of living
bumps.
increase.
Yeah.
Well, we got a good bump, and I want those to continue, and I think that we're going to see a more solid pace of them going up
but
in the
that
future.
Also means that the rate of inflation is still high in order that
it has to meet, but there has to be a person who's relying on Social Security solely has to be able to keep up with the times, to keep their lights on, to keep their bills paid.
And that's why it's so important, the younger you are, that you have multiple aspects of a retirement portfolio. Building a portfolio is having more than one bucket that you're drawing from in retirement years in order to not have to just rely on the government if you don't have to.
Well, going back to this chart, so this couple, right? They started out at $2,700. Now that they're in their 80s, their Social Security has went up to $7,500 because of the cost of living increase. So it's not a fixed amount. It does go up. And when we're doing retirement planning, there's a lot of power in that. And I have seen it, and Frank is starting to see it now too. But when we're doing these spreadsheets of your numbers, and we're showing you
Individualized.
this is a tool. This is kind of like an income weapon that we can use to help offset future expenses because of inflation that we might not be ready for.
In our planning software, we're solving to age 100 for our clients.
Yeah, we want to make sure that you can live past 100 without running out of money. That's our job. But if we can't do that, then we have to get other jobs, right?
Well,
that's our job. That is what we're here for.
Is bringing to the table.
Keeping our clients from running out of money. Okay, Frank can fall back on helicopters. I don't know what I would do. I have to go back to playing guitar and singing. The next one is the exact same couple, only they waited until full retirement age to take their Social Security. So same scenario, but by waiting, where's that picture?
16 years, slide 16 maybe?
Did I do the wrong one? Oh, I might have done the wrong one. So that one, no, I didn't. This one starts at 4,000 and goes to in their 80s.
Yeah, over 5,300.
5,900. That's less than the other one. Because they didn't start it until they are 60. It says starting at 62. What am I missing, Frank? My apologies. That's 27 and goes to 75.
Starting at age 69 and 65, right? They're at 40.
Oh, okay. So if they waited until they were 69 and 65, they would have went up to 7,500. In the other one, they started at 62 and ended in their 80s at only 5,900. Point being, moving on. I don't know. I'm just trying to make a good point. But the point being is that if you wait to start, you're starting on a higher number, okay? And then that number, it has the ability to compound and increase the income significantly more once you get into your 80s and 90s. 80s and 90s is when I have seen income start to be an issue for retirees because they retire in their 60s and now things cost more. So you want to make sure that your income is designed to increase along with retirement. Social Security is a piece of that. So what other retirement incomes can we count on that are going to be there for us for the rest of our life? Well, annuity income is one of them, right? Creating your own pension. A pension from work is another one. Rental income is probably more promising. And the good thing about rental income is that it also goes up with inflation, right? So if you have a piece of property that is paid for and you keep up with your expenses, rental income is going to go up with inflation based on the cost of what it costs to live. So if rent used to be $800 and now it's $2,800 around here. So there's something to be said for that. But the thing of it is that income is going to increase and it does help to offset inflation. The other thing is, we said the pension, they're not as available as they used to be. The other thing is creating your own pension, okay? So when you're creating your own pension, there are a few rules that you need to, or a few things, tips, I guess, that you need to consider. If you create your own pension using an annuity, well, there are 4 options that you have. Well, actually 3. There's 4 types of annuities, and 3 of them can be used to provide you an income. The first one is what we call a single premium annuity. That by definition is actually what a pension is. So the pension that Frank has is a single premium annuity. The money that he contributed all of his life through work then became a pension. But that cash value, there's no bucket of money there available to Frank. It is the pension. And that's the word that we're most familiar with, because we know that when you get a pension, you also don't get a big cash account as well. Now, so that's one. Those are not as popular anymore. They are a good tool if we have to do a strategy where, let's say it provides you say you have a client that has $4 million. We take $1 million of it, create an income for them that provides that income for them for the first 10 years. Meanwhile, so we have 10 years now to take $3 million and try to get it back to 4 by utilizing the market. So that's one strategy, where a single premium annuity can be a good income tool. But keep in mind, the $1 million that you use to produce the income is gone. You no longer have access to that cash value. Unlike the fixed indexed annuity and the variable annuity. Now, if you've listened to my shows before, you know that I'm not a variable annuity fan. I think they're way too expensive and they're too vulnerable. They're attached to the market. There's too much risk involved for what you get. Maybe if you are someone in your 40s that's not going to retire for another 20 years, we could consider it. But for most of our clients, they're retiring in the next, 7 to 3 years, in that range. So with that being said, the fixed indexed annuity produces an income. This is where you can create your own income stream, your own pension. However, you still have the cash value. That's the big kicker. And that's why they're so popular in retirement planning, because you can create the gap. So say Social Security is enough to cover 30% of your expenses.
Right.
So your expenses are $10,000. Just make up some numbers. Your expenses are $10,000 a month, and your Social Security is $4,000 a month. So we need another $6,000 a month to make sure that you can pay all of your bills without being forced to take distributions from your stock market account. Why is that important? Because of what we talked about before.
Sequence of return. Right?
Sequence of return risk. If you are forced to take distributions in a down market, you can really, do a lot of damage to your portfolio. So if you have your income portion covered and secure, then if the market is down, don't touch it. Let it come back, okay? Then that's a really big win for you in retirement, and it's a way to protect yourself from running out of money. So we have to figure out how much of your portfolio do we need. So your money, and let's go back to the $4 million scenario. This person has $4 million. They need $6,000 a month to meet that income need. So we'll say, all right, I just happen to know roughly it's going to be about $700,000, right? Maybe more, maybe 900,000. So we're going to peel off, let's just say $1 million. We're going to say, here's $1 million, just to round it off. Here's 1 million of it we're going to allocate to income. And this $1 million is going to provide that income for the rest of our life. And if that covers your expenses for the rest of your life, plus Social Security together, and the increase in Social Security for the future, to offset some of that inflation, now the other $3 million can be in the market. And guess what you can do? You can actually afford to take a little more risk than you could, because your income is secure. You know that your income is solid. You know you have a little bit of inflation buffer with Social Security. And you know that if the market is down, you don't have to be concerned how it's going to impact you and your family, your spouse, your grandkids, your travel. Right.
The fixed indexed annuity also has a beneficiary provision that was not in the first product you were mentioning.
And you can talk about some of the perks of it, like long-term care and
right. Like what other product is there out there in your investment portfolio that is going to provide potentially doubling of your income up to some policies that we see for 5 years, doubling of your income benefit for 5 years if you add the income benefit rider to your annuity, and you hold the policy for more than 2 years, can't do two. But
of all the annuities, there's only one that does that, right? Only one kind. And I preach on this because I don't want you to end up in the wrong kind. It's really important. There are a lot of different types, but they're not all good. Like you've heard people say annuities are bad. Well, some of them are. Some of them are. And I will tell you, what is that lady's name?
So a portion of that benefit, but just stay on track a little bit, is that, we're talking about a portion of that portfolio that you're building in also has, God forbid I end up in a nursing home for a long period of time. And who's going to pay? How, where, and thinking about how high that bill is, right? And you may still have a spouse living at home with all the expenses in the home that can't care for you.
So you raise a good point. So we have a couple things that we consider. Now, when we do planning, there is 5 main areas that we take into consideration and plan around. the income and investment plan are number 1 and 2. Without that solid foundation and planning is figuring out what is going to be your strategy. So we talked about Social Security as part of your income strategy. We just introduced creating your own pension. What are other strategies? But the investments support that. So if we're saying, well, one option is to invest into a fixed indexed annuity to produce your own pension, still have access to your cash value, provide benefits like spousal continuation, death benefit enhancements. You can also obviously double the income if you ever need long-term care, which is huge. Because in that scenario that I gave where we had someone with $4 million in their retirement savings, 1 million of it we peel off to provide a pension for them, and that would actually double for 5 years. So what did we say we needed? What was our gap? 6,000. So if it's producing 6,000 a month, that immediately turns into $12,000 a month, and it's one paper that your doctor signs. And it's not like the old long-term care insurance policies, which we offer and write, but because there's such other better, cheaper options that don't require underwriting, you might not qualify for it. The annuity option is a given.
Very expensive.
And they're very expensive. They're hard to get approved, and they're also hard to get claims through on them.
Now, by the way, you're listening to the Mindie Molina Show. This is a live broadcast. If you'd like to call in with any questions or comments or stories about Social Security or your financial portfolio or situation, you can call in to talk to Mindie or I. I'm Frank. The number at the station here today is 772-221-1100. It's 772-221-1100. And you can find Mindie and I at mindiemolina.com on Facebook, Twitter, YouTube, Instagram.
Just
Mindie
Google
Molina.
Mindie
Just Google.
Molina.
Mindie.
Yes. So going back to, then we're going to move on from this annuity tidbit, this particular strategy. But the key is that the income is for life. And if you don't want to put all of your money into an annuity. That is not, if you are working with an advisor and they're trying to put all of your assets in annuities, there's a good chance that's all they can offer. If you are working with an advisor who tells you, and you're discussing retirement, and they tell you annuities are bad and they just don't like annuities and blah, blah, blah. Trust me, I know them. It's because they probably can't offer it and they don't know about it. And it's not fair to you to miss out on an opportunity that could actually secure your life and not have these market risk or sequence of return risk, interest rate risk. I know CDs are paying more than they have in a really long time. I know our money markets are paying more than they have in a really long time. But how long is that going to last? Right. Is that going to last as long for the rest of your retirement? If you're about to retire, there's more than likely we're going to see another financial crisis of some sort in your retirement if you are about to retire. So why not be prepared for that and know that no matter what happens, your income is still going to come in? What were you going to add?
Well, guarantees. We're talking about guaranteed
Yes.
income in annuities.
Guaranteed.
And that's a...
So with that piece of it, you're able to take more risk, more opportunities in the market to grow. Because I don't like for an investment portfolio or an investment plan to be 1 foot on the brake and 1 foot on the gas, so to speak. I'm not as much into the whole balanced portfolio model that didn't pay off. And I'm not the only one. You can look it up and read the same articles that I do, but it's really I think allocating money to a specific, delegating that money. This money is delegated to produce income. This money is delegated to produce growth, and having a 1 foot on the gas this money you can take more risk with it because you're not going to need it to produce income. Okay, so moving on with that, the annuity structure works really, really well. So what's another way that you can produce income? We know our income need is $10,000 a month, right? We got Social Security, $4,000 a month. We got bills, our income need is $6,000 a month. We got bills that are $10,000 a month. The gap, which we call the income need, $6,000. What are other ways that we can produce the income? Well, I mentioned rental income. It's very popular in retirement. And in early retirement, it's not a bad idea, especially if you're a handyman and you don't mind the work, but it's not retirement. You become semi-retired. because it's still a business. You're running a business. You're a landlord, and it's a headache to say it's not. You may have that one person, and I've had clients who have a rental property that the same family's rented for 20 years, and they're not going to sell it just because they retired. They're using it as income, but they have a reliable, low maintenance opportunity there. That's rare. So that's rare, but it does happen, and that's good. And if that could happen for everyone, I think we'd see a lot more landlords in retirement, but we don't. Why? Because that's not what people usually want to do. Even though I do say rental income will help you in inflation. It's just that, are you going to be able to do the work that needs to be done when there's landlord work that has to be done? So there's rental income. Now, the other thing is the market. How do we invest in the stock market and get income? There's a couple different ways. One is gains, right? Value of your stock goes up, you can cash it in, cash a portion of your portfolio in, and just keep getting your income from that, taking from the portfolio each year or month, however you have it set up. We'll turn it over to Frank. What are some of the concerns about that and risk that are involved with that strategy in terms of just investing in equities and taking the gains, hopefully, that are there every year?
Well, there might not be a gain. That's the obvious one, right? The portfolio underperforms at the time when you need it. We were talking about the sequence of returns. That's could be a negative downturn. The whole could be war.
Yeah.
That drives a change in the situation that you don't have any control over.
Right. The news.
No control.
Yeah. So every day you become glued to the TV because now your lifestyle relies on what is being reported to you. Where's the market? Because that is going to matter to you a lot. Because now your life is your lifestyle is hanging on that thread, and I've seen it can be very, very stressful. So if you're investing to retire, you have to be focused on income for life. Now, that being said, dividends. There's a lot of different stocks. So let's go over some of the types of stocks. You have common stocks, and common stockholders have voting rights and the potential to receive dividends. And they're the most popular type of stock that individuals invest in, right? Then you have preferred stocks, which are similar to common stocks, but
they operate more like a bond.
Yeah, and they're preferred stockholders. They have a higher claim. So if
stockholder has the lowest claim.
Yeah, common stock is the last guy to get a payout if the company goes under.
Yeah,
The preferred puts you a step. You're more likely to get something. Doesn't mean that you will. I did see a family that lost money in a stock, and I won't say who it is because I'm remembering, and my memory is not 100%. So, but they had preferreds, and they were like, why didn't we get? Well, the waterfall, right? How far does the waterfall go down? And even though you're preferred, it doesn't mean you're at the top. So growth stocks. But, preferred stocks, though, typically do pay fixed dividends, and they provide more stability compared to common stocks. However, preferred shareholders usually don't have voting rights. So growth stocks, a lot based on the name, right? Stocks of companies with high growth potential. And investors usually seek growth stocks in expectation of capital appreciation. So if you're looking for gain, you're looking for opportunity there for income purposes, which is typically why you do that in retirement. And then growth stocks are a possibility, but they can be more volatile due to market expectations and uncertainties about the future growth. So this isn't as you're looking for opportunities of growth, not necessarily stability, long-term, stable companies, right? That's.
And you were talking about stocks, but in many cases, right, they group the stocks into mutual funds or ETFs.
Yes.
With similar category of holdings.
Yeah, and
to kind of broaden and lessen the risk.
Yeah, diversify.
Diversify.
So value stocks are when you are considering an undervalued or trading below the value. So you're looking for a really good deal, right? This thing it's selling for way less than it's worth. So you buy that. Again, growth potential for a gain to produce income. Dividend stocks. So this is kind of the one that I would lean toward. If I said, you know what, annuities aren't for me, and thank you for that strategy, because I like to show multiple strategies, the options. But what I want, when someone comes in to meet with me and they say, okay, I'm trying to figure out how I am going to retire, that is the first step. It's like getting all the information and then laying out a few different options. So just like a doctor, if you came in and said, this is my situation, we're going to do all of our diagnostic work, we're going to find out everything that we need to know in order to create some sort of recommendation for you, and then we're going to give you options. So here's option A. Option A would be maximize Social Security, make a pension with a fixed indexed annuity, and then focus on growth, in the market. And then option B would be, let's look at some of our models that are designed around providing dividends, income. And it doesn't necessarily, so we have managers. Our managers are tactical. They're not just going to focus on just dividends. They're going to look at both. We want to seize any opportunity that we can to provide you the income that you're going to need year after year. The biggest thing about being on this side with this option, though, is that there's more risk. I like guaranteed retirement because I think that gives you more financial freedom, believe it or not. And I also believe it gives you more peace of mind. There's a lot to be said to having a stress-free retirement. But again, annuities are not for everyone, and that option doesn't always isn't what they want. So this option, it allows you to be more or still be in the market, but still meeting that income need. And something else to think about, I know I said 5 things. I start jumping around sometimes. But one thing is income and investment. I said that, how important it is trying to choose how you're going to retire. And that is what strategy is best for me. And then the other thing is taxes, right? And how you take these distributions, whether it's dividends or gains, whether it's taxed as qualified or long-term gains or short-term, it's going to impact you. So that's something else we have to take into consideration when we are trying to create these strategies, because we don't want to put you in a position where, yes, we're meeting your income need, but we're costing you a lot in taxes because of it.
Right, and if you're considering making a withdrawal, we've ran into a few different clients and different people in my life recently where they're making large withdrawals before age 59 and a half out of their 401ks because they're so upset about the performance of their portfolio that they feel like there's nowhere to go. They take it out and they put it into their home to pay down a home or to get a second piece of property, but they didn't realize that tax burden, like all that money that comes out is reported as income in that year that you take it. And if you're not age 59 and a half and it didn't meet the qualification for the withdrawal, you owe a 10% penalty.
Yes.
So
yeah, having a tax,
being distressed and selling when the market is down is not a good strategy.
No, it's not. There's an emotional roller coaster. But that's why I say,
sell high.
Again, in retirement, the market can be stressful, and if you have your income solid, guaranteed for the rest of your life, and you know your bills are always going to be paid, it will alleviate a lot of that stress.
So our planning and sessions, our consultations, and the analysis of your portfolio is absolutely free. That's what we do. That's what we specialize in. You sit down and bring your statements, do a deep dive into the fact finder, your expenses, and we will go over with you. You understand you and your plan, your dreams, your goals for your retirement future, and we help you get a plan together and a possible multiple plans that you find satisfactory, and that's what we do, and that's completely free. We have an office here in Stuart. You're listening to the Mindie Molina Show. Frank, This is Mindy. You can reach us here at the radio station. This is a live broadcast. If you want to talk about anything financial, 772, calling today, 772-221-1100, 772-221-1100, and you are listening to the Mindie Molina Show.
Okay, so going back to our different types of stocks, the next one is the blue chip stocks, okay? So these are your well-established, financially stable, highly regarded companies that typically leaders in their industries, right? And their consistent performance over long periods of time, and they're usually considered like a safe investment. History of weathering the storm.
Maybe cross over into some of the other categories. The blue chip certainly could be a good dividend-paying stock.
Absolutely. And
Good growth stock.
and then the other is your small cap, mid cap, large cap stock segments, I guess, how they're organized, how big the companies are.
Their market share.
Yes. So let's go back to our dividends, because I want to, now that we've kind of talked about a few of the different types of stocks that you can have, I want to hone in on the dividends, because that's a lot of times when people come in, that's their focus, because they're retiring and it's like, well, how do I get income out of the stock market? And the first word that comes to their mind is dividends. So this is what I have to do. How am I going to be able to do that? And I've met a couple people who've done well for themselves, right? In retirement, they do a good job managing their own money and producing their own income. Although both cases that I'm thinking of did experience some bad years, and it's tough, but you got to fight through it and keep working, because again, managing your own money is also a job. It's like being a landlord, and you have to stay on it. And a lot of times I will encourage the investors that are knowledgeable or savvy investors, like I call it, that they keep a piece of that we segment. Yeah, this is going to be for income. This we're going to grow and preserve, right? We don't want to take risks. No one on my team is in the business of losing money. We don't like that. So, but that being said, so now we have our plan in place. Well, you can actually afford to peel off a certain amount of money. Here's in our other example, we got a $4 million portfolio. If my client wants to keep 500 or $1 million of it under his own management or her own management, I'm 100% supportive of that, because I think that it keeps them engaged, also keeps us accountable to producing results for our clients, and that our money managers are able to knock it out of the park, so to speak, because being independent and being able to hire and fire money managers, wealth managers, is our position, being able to bring the absolute best that we can find to our clients. So I love for my clients to stay engaged, but most of them are just playing the market and kind of going for the gold, I guess, taking the more risk that we're not allowed to take with their money, and then they know they have everything secure. So, but going back to dividend, this is just a little bit of information on dividends, because for those of you who are considering that strategy, right? So we talked about the one strategy with the annuity. This is a different strategy where you still are in the market. Annuity is off the table. Here's a little bit of information on dividends. So one of the things is you want to look for companies with a long track record of consistently paying dividends, and companies that have maybe increased their dividends over time. That demonstrates financial stability and commitment to rewarding their shareholders, right? So that's one thing. Another thing is yield, dividend yield. So you want to consider what is the dividend yield, and that's the yearly dividend payment divided by the price of the stock price. So the higher that dividend yield, that's an indication of higher potential income. So you want higher yield, higher income potential. So look for that. But you do have to be cautious of extremely high dividend yields. You want it to be reasonable, because you don't want that, is it bait and switch? You know,
over leveraged.
Yeah. So you want to, because if it's a look too good to be true kind of thing, it could be an indication of financial distress, and they're trying to pull in more money by holding this, dangling the carrot, as they say. So watch out for that. You don't want it to be outlandish. You want it to be reasonable, but a good high dividend yield. Payout ratio is another thing. So you want to evaluate what they call a company's payout ratio, and what that is that's the percentage of earnings that they pay out as dividends compared to the overall, so you want it to be under 50%. So a substantial payout ratio is generally considered to be around 50% or less. A higher ratio might imply that the company is paying out a significant portion of their earnings. Okay, so of the earnings that they're paying out, based on the overall earning, right? So the proportion, I guess is what I'm trying to say. Whatever that proportion of the earnings is, if it's over 50%, again, could be a red flag. Like, why are they paying out so much of their earnings, and are they leaving themselves in a position where they don't have room for future growth, or most importantly, unforeseen circumstances? As we know, one thing could come out on social media tomorrow and then everything's changing. So it's important for them. You want the companies that you're investing in to have stability. And if they're paying out most of their earnings, that might be a red flag. But you do want to be close to 50%. Sector and market conditions. Do you want to do that one? Are you tune in?
The sector and market conditions, we would you're assessing the overall health of the sector in which the dividend-paying stocks belong. So which part of the market are you in? How's that part of the market doing? Some sectors, such as utilities or consumer staples, are known for their stable dividend payments. All right, that makes sense. All right, we always got to have your electricity turned on, and you always got to have bread, eggs, milk, staples. However, economic conditions and market fluctuations can impact dividend payments, especially during periods of economic downturns or market volatility. So, being aware of those sectors and what's going on.
Right. If you're investing in some sort of biomedical or the healthcare sector and it's not doing well, then it might be time to transition into tech or something different that is doing well. So being mindful of that overall sector is really, really important. And that leads right into the last tip we have, which is diversification and how important that is. Diversifying those sectors, for example. So not just putting all of your eggs into one dividend because it's paying, this one stock is doing really well and we want to put everything in that. You want to diversify, and I would diversify across sectors as well, not just
mention, right, that not every dividend paying stock is on the same cycle. So you could where it's quarterly, monthly at different times in the year where you receive your dividend, and that could balancing out an annual strategy for income.
Yes. So that is your dividend tips by Frank and Mindie. So that's two different income strategies that you can expect us to kind of give you a rundown on, right? If you meet with us to create a plan. One is, again, maximizing Social Security. That is really crucial, seeing how that's going to play into all these things. And one of the things I'll add about Social Security is that, let's say that you're doing more of a market-focused, dividend-seeking strategy for income from the market, whether it be gains or dividends, and then the market takes a downturn and we're deferring Social Security, trying to get you to age 70 so that we can lock it in at the absolute highest mark. Well, let's say at 68, the market takes a downturn and now we're in a financial crisis and the market isn't producing the income that we wanted to have in order to push Social Security off. Well, guess what? We can just start Social Security. So all of our planning is flexible. All of our ideas are that we live in real time and we make adjustments in real time. And our planning is not just one and done, it's a journey. We stay with you all the way through it, and that's part of the fun that we like.
And realizing until, a lot of people, been my experience, and I'm certainly it's yours, Mindie, that people want to know, well, what's the figure? How much do I need to retire? Like that is not a good strategy to think about. So that's why detailed financial planning is so crucial, because yes, you can think about that number, but there's so many variables in a retirement plan and going through in the future that we just don't know and can't plan for. This is why you have to have a sound planning strategy.
There are so many
There's
people
not a magic number
right now driving home from work who could retire today. They probably
because they just never took the time to run the numbers. The math
they don't
doesn't
know.
lie.
Yeah, they just
That's
don't.
Favorite statement.
Yeah, numbers don't lie. But there are so many people that are working, that are possibly miserable, who could retire and don't know it. That's
right.
That's just
true.
the truth. But or they think I can't retire until I reach until I'm eligible for Social Security, or I could never retire until my wife is old enough to be on Medicare. And some of these things are just in your head. You know, they're really not true. And there is a way to work around it. Waiting until your spouse makes it to 65 so that you both have health care could be it could be as simple as just creating a little strategy to offset that expense, and then you can retire and enjoy things while you're young, while you're in that go phase. Okay, go, like Frank said. When you're in the retirement portion of your life where you can still go, it's so much better. But what happens is people put off retiring because they think I have to wait for Social Security until I'm full retirement age, or I have to wait for Medicare. And then by the time they actually retire, they start to get into the slow go phase. It's kind of too late, you know? They didn't get to enjoy it. And that part of it is never fun. The last scenario, because I wanted to give 3, the last scenario is that head in the sand scenario. Okay, that's where you don't do anything. What if you don't do anything? You keep doing what you're doing, you go to work every day, you keep contributing to your 401k that you hope is doing well, and you pick the asset classes that seem right, target funds that I also don't like, and you just keep trucking along, and you never have a true analysis by people who really know,
financial professionals,
right? Like me, but then that's an approach. That is a scenario, and that is a reality for so many people. They won't take action. What was my word for the year? I just said it. Action.
I'm not sure, but what many folks like, knowing that you have a job and that you have some savings, and people just put off doing the detailed planning. How much do we see that where they're just, I'm not taking the time? We have clients that we've been trying to sit with multiple times.
Your question was, how much does someone need in order to retire? And the very first meeting with us is going to be going over all of your expenses so that we can determine how much money you're going to need in order to retire. So it's a question that only you can help us answer, because everyone's lifestyle is different. Some people live off $2,000 a month. Some people, they need to have 20. You know, it just depends. And so it depends on your lifestyle and what your needs are. And the thing with us is that the most important thing is that whatever your lifestyle is, we want it to stay the same for the rest of your life without you ever running out of money.
We haven't even talked about really and considered legacy planning. Like, you know, some folks, it's important that they want to leave a legacy for their heirs.
And when you're talking about income and these plans, spousal continuation is such a key factor, which is part of legacy planning, right? So we said taxes, income, investments, taxes. The next 2 important portions that come after those plans are in place is legacy and long-term care, making sure that if something happens to either one of you health-wise, or either one of you go to be with the Lord, then the other person is able to continue on with financial security. And that, again, income is such a huge portion of that, because what happens to your Social Security when your spouse passes away?
Right.
Their Social Security goes away, or yours. You get to keep whichever one is higher, but you don't get both of them. Okay? So we need to plan for that. We have to be prepared for that to offset that. How much more time do we have for the show?
About 4.5 minutes.
Four minutes.
Oh, 4 minutes or so. Okay, good. So the biggest thing is making sure that the plans are in place, because a plan is what's going to give you peace of mind. And if you have peace of mind, financial stress is so big in retirement. It's not just for young married couples. One of the biggest reasons people get divorced, financial stress.
And the young folks out there listening, like the earlier you start your planning, the less
Yes.
in detailed planning.
If you have come to a position, I'm very, very excited. My niece is about to get married. She just became a doctor. Well, shout out to her. And her fiance, they both have, graduated college. They've got
Lots of debt.
good careers ahead of them. Yeah, lots of debt.
More than likely, if she
God
just
love
finished
them.
the
They both
PhD
need new
program.
cars. They both need cars. I mean, I don't even know how they're making it up and down the road at this point.
I kicked you off your train of thought.
Let's just get past the wedding. But but this is the key moment in their life where financial planning needs to start. This is the key moment, because if we can get them on track right now, then the rest of their life, their plans, their goals together, being able to build a solid foundation of financial security, the odds are they're going to have a happier marriage.
And our office is in Stuart. All our planning is free. Our consultation, planning, multiple planning and consultation via Zoom.
And we have really good coffee.
Our office is in Stuart. Find Mindie Molina Investments and Insurance. You can find us at mindiemolina.com.
We thank you all for being a part of our show and listening and tuning in every week, and hopefully learning and learning and learning. We haven't repeated ourselves. We've been just trying to cover as many topics as we can every single week, and we're really blessed to be here for you and to teach you. And we ask you, share the information. You can go on YouTube, you can share our videos, you can share the live video of this show on our Facebook page. And continue to tune in and just support. If you know anyone that's about to retire, send them our way. We know we can help them. We're pretty confident in it. Yeah. So thank you so much, and we're gonna keep talking because we've got more time apparently. Why don't you share a verse with us, Frank?
We have honor the Lord with your wealth, with the first fruits of all your crops. Then your barns will be filled to overflowing, and your vats will brim over with new wine.
Amen.
So.
We have 2 more minutes.
That's from
we got the wrong cue.
Proverbs 3. Yeah, honor the Lord with your wealth and with the first fruits of all your crops. And so knowing the conditions of our crops.
So do people still tithe when they go into retirement?
Frank does. I plan on it. I don't know about that.
Are you
If you're a
retired?
Christian, well,
Yeah, see? David retires. We got Dave over
No,
here.
we have
He's the
some-
producer.
we have
Let
some
me just give a little shout out to... what am I doing? Hold on.
in
Let me
the
get
Hebrew-
shout out to David.
in the
Wave,
Hebrew,
David. I'm going to give our viewers a nice view of the studio over here. So, absolutely. You want to keep tithing. And is that a portion of our expense report, Frank?
Sure, better be.
It is.
How can you-
Gifting.
10%. That's the minimum, from some people's perspective. The minimum, the Lord.
We get really detailed with our expenses, and if there's anything that I haven't thought of that is on that expense sheet, then we easily add it. But charitable giving is certainly on there. And if you've never watched my charitable giving podcast or presentation on YouTube, it's very, very good, because I believe in the power of contributing to the church and tithing. And what you just said, that verse that you just read, is so powerful, because we want to live a blessed life, not just now, but also when we retire, we all do. And then when you're planning on your legacy, including the church, right, is such a huge factor. And it's such a powerful passion of mine. And you'd be surprised of how often that gets left off the table. So, but don't you worry, Mindie always brings it up. And now I think our show is about over. I'm very thankful again. And like I always say, God loves you, and there's nothing anyone can do about it. Be blessed. Thanks for listening. Join me next week, and if you have any questions, you can reach me at 772-872-6332. Again, that's 772-872-6332, or at mindiemolina.com.
Mindie Molina Investments and Insurance has been protecting the retirement of families for 15 years. They can be reached at 772-872-6332 or at mindiemolina.com. Advisory services are offered through Aegis Wealth Management Incorporated. The firm is registered as an investment advisor with the SEC. Information provided by Mindie Molina Investments and Insurance and or its affiliates are for informational purposes only and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy.